So, Taylor, we've just discussed the jack of all trades trap, where DIY investors try to become experts in everything financial, often spreading themselves too thin. This can lead to critical oversights, as we saw in that couple's estate planning. But even if someone does manage to grasp the basics of multiple financial areas, there's another hidden danger lurking: our own emotions. This brings us to our next scenario: the panic seller. Imagine this: the market takes a downturn, maybe even a steep one. News headlines scream about impending economic doom. A DIY investor, let's call him Mark, sees his portfolio value plummeting. Fear grips him. He panics and sells everything, locking in his losses. Then, just a few months later, the market rebounds. Mark sits on the sidelines, watching his former investments climb back up, wishing he'd held on. He's locked in his losses and missed the recovery. This, unfortunately, is a classic example of emotional decision-making at its worst. Sam, what are your thoughts on this common pitfall? How can individuals manage their emotions during periods of market volatility?
Excellent question, Alex. Managing emotions during market downturns comes down to having a predetermined plan and sticking to it. Think of it like a fire drill. You don't wait until the fire alarm goes off to figure out your escape route. You plan ahead. Similarly, an investment plan crafted during calm times acts as your guide when the market gets turbulent. This plan should outline your risk tolerance, investment goals, and a clear strategy for different market scenarios.
So if I understand correctly, it's about having a roadmap before the storm hits, so you're not making decisions based on fear. That makes a lot of sense. This reminds me of what we talked about earlier with the information overload. Having a plan helps you avoid getting swept up in the panic.
Precisely, Taylor. Without a plan, you're susceptible to what we call emotional contagion, where fear spreads like wildfire, driving irrational decisions.
What strategies can help DIY investors avoid these impulsive financial decisions?
Beyond a written investment plan, several strategies can help. Diversification is key. Don't put all your eggs in one basket. Spreading your investments across different asset classes can cushion the blow during downturns. Regularly rebalancing your portfolio, meaning selling some winners and buying some losers, is another helpful tactic. It's counterintuitive, but it forces you to buy low and sell high.
That rebalancing idea is interesting. It's almost like taking emotions out of the equation by following a set process. Does that mean automatically rebalancing at certain intervals?
Exactly, Taylor. You can set it up to happen quarterly or annually, so you're not tempted to react emotionally to short-term market fluctuations. Finally, and perhaps most importantly, understanding your own biases is crucial. Recognizing your tendency to panic or get overly enthusiastic can help you preemptively address these tendencies.
Those are excellent points, Sam. Let's recap. First, develop a written investment plan. Second, diversify your investments and rebalance regularly. And third, be aware of your own emotional biases. These steps can empower DIY investors to navigate market volatility with a clear head. For now, think about creating that written investment plan and seriously consider working with a financial advisor. They can offer an objective perspective and help you navigate those inevitable market fluctuations. They're like having a trusted co-pilot in the cockpit of your financial journey.